So I'm Ken Wotton. I am the Managing Director for Public Equity Investing at Gresham House. And Gresham House Asset Management is the manager for Strategic Equity Capital plc, London-listed investment trust, focusing on UK smaller companies, but with a bit of a twist. So some important information, and a lot of it is similar to what Roland has already covered, so I won't verbalise it all. So, Strategic Equity Capital plc, as I said, it's a London-listed investment trust with a market capitalisation of around about 150 million. And our objective is to achieve capital growth in the value of the investments over a medium-term period, which for us is about 3 to 5 years. And that's principally through capital growth. We do that in a very concentrated way. So we take a relatively small number of positions. We take larger equity stakes in those positions, and then we try to actively engage with the management teams, boards, and other stakeholders of those companies to try and drive shareholder value over that time period. And here we go. So some of what I've just said. So we are small cap specialists at Gresham House, and Strategic Equity Capital I regard as really the flagship or the pure play version of our investment strategy, which has been I've been working on for the last 18 years, 6.5 of those at Gresham House, and prior to that at a private equity firm called Living Bridge, where there's been continuity of strategy and team. We focus on the small cap part of the UK market. We think there are some fantastic opportunities in that part of the market, particularly at the moment in the current market environment. And if you take an actively engaged approach and a really, really concentrated, high conviction view of the companies, we think we can avoid some of the pitfalls of the volatility in the markets that we're seeing at the moment, and capture some of the opportunities that result from that kind of the big picture macro and sentiment driven volatility. So what do we do and how do we do it? In terms of philosophy, we talk about taking a private equity approach to investing in public companies. And what do we mean by that? Well, we mean that we are sort of sit somewhere between, in terms of our strategy, between a typical public equity portfolio, which tends to be managing risk through diversification, be relatively passive in terms of the interactions with the individual companies, and is targeting returns which are typically linked to outperformance versus a relative benchmark. So we sit between that and a private equity approach, which is more difficult for retail investors in particular to access, where you're taking a very illiquid positions, taking a long-term view, being very active in terms of the engagement with the companies, and typically using leverage to enhance returns. So we think by sitting somewhere in the middle of that, you can get some of the good bits of private equity, i.e. the engagement, trying to minimize downside risk by being really clear with the management team what you expect as a large shareholder, reducing the risk by not having the leverage in the structure, and having access to sort of less liquid investments than a typical large cap fund would have on public markets, but more liquidity and therefore more flexibility than a typical private equity fund would have. So that's kind of how we position ourselves. And one of the things which really allows us to do that and be effective at doing that and is the network that we built up as a team and a business over the last 15 plus years of trying to apply this strategy in the UK public markets, particularly at the smaller end of the cap spectrum. So we have a well-invested team at Gresham House. There's 6 people in my direct team that are managing or being involved in the investments of Strategic Equity Capital. We also have a very well-developed private equity team within Gresham House, colleagues that sit adjacently to us. There's 29 people in that investment team. We try to leverage their knowledge, their skills, their sector expertise to help us with our public investments. And then we have a series of advisors and investment committees that sit around the business, providing either sectoral expertise or situational expertise and industrial expertise that we can tap into to help us to make better decisions. And then the last bit, and probably the most important, is that all of those people that sit around our business have their own personal networks of specialists that sit in all these various buckets that you can see at the top here. So non-exec directors, chairman of public and private companies, commercial due diligence providers, specialist consultancies that are advising companies on digital marketing strategies or M&A or other aspects of their business. You have sector experts, you have functional experts, and these are all people that we can potentially call upon through our own direct network. So these are people who have direct relationships and have worked with, and therefore are trusted colleagues and contacts of people that we know and work with. And that is very difficult to replicate. It's taken us 15 years to build it. Most of our competitors don't have something similar to this. This is quite a private equity style sort of setup. And we try to use these experts to help us originate ideas, evaluate companies when we're doing our due diligence on them, and then also potentially to get involved in those companies after we've invested, which again is part of our differentiated approach to active engagement with the companies. So that's our network, which is a real key USP and differentiator of our approach. And then I've talked about active engagement a few times, and what does that actually mean in practice? Now, these are public companies, and therefore we don't have majority control like a private equity firm might do. So we can't just tell them what to do and expect them to do it. But we can engage by using a larger equity stake. So typically we will try to become either the largest or one of the top few shareholders in a company, such that the board and the management team and other stakeholders really need to engage with us on things that we think are important. And that might be, we've tried to sort of frame that on the right-hand side here. If you can't read that, there's things like strategic advice to the board. So trying to ensure that the companies are really clear and focused about their strategy and how that links to shareholder value. We may be a provider of cornerstone capital for them to do acquisitions or to invest in their business in new growth initiatives. We engage with them on trying to enhance and optimize their board composition by potentially introducing people that we know that are high quality that can help them. We try to get involved in the design and the implementation of management incentive schemes that genuinely align to long-term shareholder value creation rather than just sort of paying the management team for mediocrity. We might advise them on how to engage with the capital markets on investor relations and tell the story better so they can drive marginal interest in their shares. We may support M&A activity, and that might be the company acquiring businesses, or it might be either defending against unwanted takeover approaches or enabling attractive takeover approaches depending on our perspective, and that's pretty topical in the current market. And then access to our network and to best practice that we see across our platform, both in public and private companies, and trying just to help the companies to be as focused and as high quality as they can across all aspects of their business. And we can do that, as I said, because we take a larger equity stake in the companies, and whilst we're not trying to be activists and force companies to do what they don't want to do, we are trying to help them and support them in a collaborative way. And we think that helps to mitigate the downside risk of companies by keeping them on track. It can potentially unlock catalysts which can drive value for businesses. And as a result of that, we can potentially make things happen in companies, which means that they can perform and deliver value even when the stock market is going down or up or sideways. So we don't rely on the markets to perform for us to make money for our investors, we hope. And it's been successful. I won't dwell on this, but we've won lots of awards across the years for our funds, particularly around the UK small cap space. And so it's nice to get third-party external endorsement of that what we're doing is actually working. So it's an interesting time in the market, and you're all active investors, so I probably don't need to tell you that. But so it's a time where it's quite difficult to navigate what's going to happen. So I think what we're trying to offer with Strategic Equity Capital is an investment proposition in an area which is, we believe, chronically undervalued, and therefore there's lots of opportunities, but with a strategy that can try and de-risk that from some of the macroeconomic and geopolitical factors that are swinging markets around, and enable companies and therefore our shareholders to drive value despite the uncertainty. We don't need the UK economy or the stock market to be performing really strongly for the companies we're investing in to be able to deliver value. And this is just a bit of an indicator of the value opportunity. So the left-hand chart is showing you the relative value on a PE multiple basis of the UK equity markets in aggregate against global equities. And obviously that's quite skewed towards the US. And whilst there's been a bit of a sort of modest pickup over the course of this year to date, we're still, even despite that, at 30-year lows in terms of the relative valuations of the UK market in aggregate versus other global markets. And then within the small cap space, the smaller you go, the bigger the discount is versus larger companies. So you've got a double discount that we're trying to play into. The UK market, which is underappreciated and therefore undervalued in our view, and then UK small caps, which are even more so. So that should be a good sort of starting point to make attractive returns for our investors. And it's not just us that think that. So the UK public markets may be undervalued, UK small caps may be undervalued, but it's not purely because the UK itself is out of favour. And that's demonstrated because there's been an elevated level of takeover activity, so public companies being taken private, both by private equity and also by larger corporates who are specialists in particular areas. And they can see that certain companies that are listed on the UK market are high quality, that they have good long-term prospects, and yet they're trading at valuations which are somewhat disconnected from the fundamentals of those businesses. And so that's been driving a really quite elevated, certainly in my career, elevated level of takeover activity of UK companies. And that can be a blessing and a curse, but it can drive significant value uplifts for our shareholders that are exposed to that. And as you can see on the right-hand side of the stats that we've got there, almost a quarter of the holdings by name that we have owned in this fund since I started managing it in September 2020 have ended up being subject to takeover offers. So that's a big proportion. The average premium on the day of the announcement was 32%, but that doesn't give you the full picture of the returns we've got. And the average valuation multiple, so we look at enterprise value to EBITDA as a metric because you can compare that quite easily with private markets. The average multiple was 13.3 times. And remember that number because in a minute I'll show you the valuation of the current portfolio, and it's currently a very significant discount to that number. And this is takeouts that we've had over the last 5 years, so through the period of the market discontinuity we've seen. So this is evidence that some of the companies we're investing in, certainly to the eyes of private equity and to corporates, if not UK listed company investors, look very undervalued and therefore look attractive to take private. I won't go through these in detail, but strategic equity capital, SEC as we refer to it, is a very concentrated strategy. This is really our best ideas at Gresham House in the UK small cap space, where we believe we can take a larger equity stake, and by doing that, we can either support or make something happen which will unlock value. We have 17 holdings in the portfolio in aggregate, and the majority of the value, at the moment, almost 80% of the total NAV of the fund is in the top 10 companies. So these are the top 10 companies. I'm happy to take questions on any of them in a minute, but I'll just give you a couple of case studies of kind of how our approach links in with some of these names so that you can get a sense for what we're looking for and how we operate. But before I do that, I promised you that I would show you the valuation of the portfolio as it stands today. So as I said, the top 10 holdings represent almost 80% of the value of the fund. So those are the companies that are really going to drive value for SEC shareholders over the next few years. And we think that the aggregated financial and valuation characteristics of those companies are really quite compelling. So we like high quality companies. We like businesses that have strong balance sheets, high margins, good margin of safety, so that if there is uncertainty and things come out of the woodwork because of the uncertain economy, these businesses should be resilient and be able to withstand that. So we've got companies that are growing. They're growing their top line at nearly 9%. They're growing their profits, their EBITDA at low double digits. So they're attractive growth businesses, but they're not growing at breakneck speed, so they're going to fall over. They're high margin businesses. The average EBITDA margin is over 20%, so we think these are high quality businesses, and they have very low financial leverage. In fact, in aggregate, the companies that we've got in this portfolio have net cash on the balance sheet. So that means that they should be very resilient and be able to withstand the uncertainty that we're seeing. And you can buy all those characteristics on an enterprise to sales ratio of 2 times or an enterprise value to EBITDA of 8.3. And so I said, remember that number from the previous slide. So if we go back, I'll just say, in case you didn't remember it, the average multiple that the companies that we've had in this portfolio that have been subject to takeover offers, the average multiple that was paid for those businesses was 13.3 times. That's a 60% premium, 60, to the current value of the portfolio, which is 8.3. So that we're not expecting every company to be taken over, but it does give you a good sense of the margin of safety we have on valuation if these companies can perform. And if you apply those metrics and you roll them forward over the life of our typical investments, so 3 to 5 years, then extrapolating, this is purely indicative, this is not a forecast, but if you extrapolate those growth rates and then you segment them between the earnings growth drivers, the cash generation of the businesses over the life of our investment, and the rating of these companies, and we assume a modest re-rating, you can illustratively get from a current NAV per share of SEC of around £4 a share to well over £10 a share, just by kind of rolling those metrics forward over the 3 to 5 year time horizon that we invest on. So that's the kind of view of the potential upside of this portfolio. So I'm going to give you 3 in my final 4 minutes. So I'm going to do one per before questions. I'm going to do 1 case study per minute. So Ricardo, this is an environmental consultancy business that was going through a business transformation that we backed a couple of years ago. We became the largest shareholder in the company with just over 20% of the equity. And this is a case study of where something's gone a bit wrong with the company. The external environment has got tougher, and they had a profit warning. The shares fell significantly. But because of our equity stake and our strategy, we were able to step in and catalyse something which recovered all of the value for SEC shareholders. So I don't often want to trumpet a situation where we've made a sort of 0% return, but we didn't lose money on this investment because of what we did over the last few months. So they had a profit warning in January, and we engaged very proactively with the board, both the execs and the non-exec board, in particular the chair, their advisors, so in particular their M&A advisor, as well as an activist investor that had joined the register following the share price fall. And as a result of that, we evaluated different sort of potential routes to recover value, and we used our position on the presence of an activist investor on the register, and put a lot of pressure on the chair in particular to deliver an outcome which was going to sort of catalyse a recovery in value. And the outcome of that was a recommended takeover offer from WSP, the big Canadian listed consultant, for the business, which entirely recovered all of the lost value from the profit warning. So we were sort of slightly sad to see it go, but we felt the risk profile had completely changed after the profit warning, and this was the best outcome for us. And we were able to put a lot of effort into that over the space of about 4 to 5 months to make that happen. The second case study is a more traditional case study of a company which was undervalued and overlooked, and people had kind of been prejudiced against it because of prior sort of missed expectations. And we saw a really high quality business in a good market which had the recovery trajectory. So we became the largest shareholder in this company, XPS Pensions. It's a actuarial consultancy business and pensions administrator, so particularly focused on defined benefit pensions. There's in an area of the market which is not cyclical, it's driven by regulation. You have to do your triennial valuations, you have to communicate with your members, you have to pay your members, you pay your pensioners, and they provide all the support around doing that. This is an area which has had significant incremental regulation, and that's driven activity for the business. They're also, they've been a beneficiary of inflation because they're a business that has long-term recurring contracts where they have indexation in their pricing, so they're able to put their prices up by inflation every year. So when we had the big spike in inflation a couple of years ago, that was actually quite positive for the revenues of this company. And by being the largest shareholder and really trying to focus the management team on being clear about how they were going to drive value in the business and stopping doing non-core activities and focusing on the kind of key value drivers, also by encouraging them very strongly to improve the quality of their non-exec board and get some more commercial people onto the board rather than actuarial and pension people on the board. we feel that we supported the business to really be able to deliver on its equity story. And over the past 2 years, it's had a number of forecast upgrades, which have driven the share price. It's moved into the FTSE 250, and we've gradually been taking profits as that's sort of started to come through in the share price. So a good example of a company just starting to deliver, which is overlooked, and us supporting value creation rather than really fundamentally changing anything. And then the last one, this is one of our key existing portfolio holdings, so it's about 10% of the trust, and it's a company which we believe has very significant upside over the long term. Again, we have built a position in this company where we are now the largest shareholder. We have 21% of the equity of the company. Brooks Macdonald is a national wealth manager, so it provides financial advice and discretionary fund management services to high net worth and mass affluent investors. It's an area which has seen a lot of consolidation due to regulatory burden, but also due to economies of scale in the sector. And there's been a lot of private equity activity in this sector, buying up businesses at really quite attractive prices. And because the UK stock market is out of favour, and because the UK smaller companies are out of favour, this company has been a little bit left behind. And so its valuation stands approximately, well, depending on which comparisons you use, between 50 and 100, between 30 and 50% discount to transactions that have happened in this sector, and there's been a large number of those. So we think this is primed for a re-rating on the market, and we believe that it will do that when it starts to demonstrate organic growth in its asset flows, which we think is a fairly imminent phenomenon. If that doesn't happen, we are the largest shareholder, and so if management don't deliver, we believe this company is an extremely attractive asset, either to private equity as a platform for consolidation in private markets, or as an acquisition for one of the larger consolidators in private markets. And because of the valuation, we think that either the company will deliver on the market and do what XPS Pensions has done and be re-rated gradually, and we'll be able to sort of exit our position at higher prices over time, or if it doesn't deliver, then there's an alternative option to get value, which is through a takeover situation. So I've raced through that and I've gone way over my time. But so just to summarise, SEC is a very distinctive UK smaller companies investment trust. It's a real pure play of the Gresham House private equity approach to public market strategy, which we think we're very, very well resourced to deliver, and we have a good track record of having delivered that across a number of different funds. SEC has a really, in our view, compelling set of companies where we are one of, if not the largest shareholder in all of them, and where we are proactively working with the board, the management team, and other stakeholders to try and unlock that value for SEC shareholders. So I'll stop there, and I will have 7 minutes worth of questions.
Hello, thank you for the presentation. What can you tell me about Costain, please?
Costain. So I summarise the investment case, or what? Yeah. So Costain, you'd probably be familiar, is a large UK consultant and contractor focused on the infrastructure space. So it does very large infrastructure projects. It will help to consult on the design of those projects. It will then project manage the implementation of those projects. So it will range from sort of components of HS2, the bits which are actually happening rather than the bits which are no longer happening. It will consult with large water companies on big water projects. It works with Babcock and Davenport on the submarine project. So it's 100% focused on large-scale, multi-year, UK-only critical infrastructure projects that we believe have a significant budgetary tailwind. And it's not all government direct contracts where you might have some concern. They've done a brilliant job over the last few years of diversifying their exposure away from just pure direct government contracts to large blue chip organisations. So it's a business that is engaging right at the sort of ministerial or C-suite level in its clients. So it's adding significant value. Yet, because of high-profile failures a few years ago, like Carillion and Kier, the business and the sector has been an area which a lot of institutional investors have just stayed completely clear of. The shares have done very well over the course of this year, but we think it's still chronically undervalued relative to the long-term potential of the business.
Other questions for Ken? I was going to ask, I saw a presentation from Retail Book a couple of weeks ago, who were talking up the IPO pipeline for the remainder of this year, maybe into early next year. Would you come in on an IPO? What are your thoughts about for SEC participating in IPO? And do you also see that pipeline involved in those sorts of conversations from the other sides of Gresham House?
Yeah, so number one, we have historically over the years been active in the IPO market in the UK small companies space. We think because of our position sort of at the crossover between public and private markets, often we're able to evaluate and diligence a company at the point of IPO due to our contacts in private markets, so we can assess the people, the track record in a way which a lot of private and public market investors either can't or are unwilling to do. So we've historically been active. The IPO market has been fairly quiet over the last couple of years because the markets have been challenged and there's been more companies being taken private than there have been listed on the stock exchange. We did participate through other funds that Gresham have in one of the largest IPOs in the first half of the year, which is an AIM-listed company called MHA, which is an accounting services business. So we have been active recently. And absolutely, SEC, if we believe that we have the opportunity to take a larger equity stake and we can see an engagement angle that fits the strategy, then where we can add value or support value creation, then we absolutely would consider an IPO or potentially even a pre-IPO, as long as we have high confidence that it will list in the short term. So the answer to the question is yes. And in terms of the sort of pipeline of activity, we've certainly had more early look meetings about potential IPOs in the last few months than we've had for the last 2 or 3 years. Whether they end up turning into IPOs obviously will remain to be seen and will be subject to market conditions, but I certainly feels more optimistic than it has for a couple of years.
Would you see or feel that be a read across then to potential valuations for smaller companies? If they get away, if there's enthusiasm, would that translate to the wider?
Yeah, I think one of the reasons, it's not the only reason, one of the reasons why there's been fewer IPOs is because valuations are very depressed. And so if you're looking to do something as a founder or as a private equity house looking to exit a business, if you can get double the valuation in private markets, then that's quite a difficult decision. If that gap narrows, then that decision is a lot more nuanced, and then there's the advantages of public markets will become more apparent. So I think you need to see that valuation gap close a bit before you see a big groundswell of IPOs. But there are lots of businesses, MHA, the accounting business, which had a very clear reason why an IPO was a better route for that business. So these idiosyncratic situations still exist. And there's also lots of companies that are owned by private equity where they kind of should have exited 2 or 3 years ago, and they haven't, and they're overdue to exit. And eventually, there's going to be a sort of unlocking of that, and some of that will come to the public market. So the timing is difficult to predict, but we do think that just that there are signs for more optimism that we're seeing in the market on the ground.
Any questions for Ken? Gentlemen here, please. Have you got a microphone?
Does your company invest in penny shares?
In penny shares?
Yes.
Not as a sort of component, not as a proactive part of the strategy. I'm trying to think if we have any. So we don't have any current penny shares. Our starting point is the value, the value proposition of the company, the fundamentals of the business. Do we think this is an attractive business? Can we buy it at an attractive price? And then whether the shares are sort of 3p or 300p kind of is a sort of secondary consideration after that.
And final question here, please.
How often do you change portfolio? For example, Costain is a cyclic business. So how often you revalue and say, oh, this is the time to sell Costains and
so typically our portfolio turnover will be around 20 to 25% per year. So it will be that which is consistent with holding a company for 4 to 5 years on average. But each individual situation is different, and turnover has been higher over the last 2 or 3 years because of the takeover activity. So we've seen more of our companies getting taken private in takeovers, and so we've had to replace those. Something like Costain, it's in a cyclical sector, but we believe that the company itself is playing into structural growth themes because it's purely focused on infrastructure. It doesn't do general construction. It doesn't do office buildings and other things which are more cyclical. So we believe that there is a long-term structural trend that's benefiting that company rather than it being cyclical. So we're not trying to call timing on a cycle.
Has it been shown by historic trends for Costain?
So Costain has shifted over the last decade or so. It's shifted from being more general to being more specifically focused on infrastructure. And so over the last 5 years, it's delivered a sort of improving trend in both revenues and margins, which has eventually been starting to be shown in the valuation. So if you look at the share price chart over the last 3 or 4 years, it's been positive, but when we've been patient. But it's still, the valuation is still not very high versus long-term history or versus other market-listed companies.
Okay, thank you.
Lovely. Ken, thank you very much indeed. Thank you for the presentation.
Okay. Thank you.